Thank you, Piero, to coming to joining us today. And
Thank you
this is
for having me.
Okay, it's your first interview in Taiwan with Money DJ, right?
Yes.
So we are flattered and want to see your perspective, especially in Europe, because you are the fund manager of the Euro Higher Bond, right?
Yes. Yes, I've been managing the fund for 7 years, and Europe, it's an old continent, and Europe has gone through a very deep recession after 2008 and 2009, and we, in particular, internal demand has gone down because unemployment going up. 2014, we start seeing things reversing a little bit in some countries more than in others. So Spain, Germany, and England, UK. 2015, we have seen a continuation of this trend, a positive trend, and we expect this positive trend to continue also in 2016. There are a number of reasons. First one is the oil price, energy prices coming down are a very good news for the European consumer because Europe imports oil. Second reason is ECB purchasing program that is definitely helping sentiment within the Eurozone, and also is helping banks lending more because the problem we have, banks not lending, and also I would say, obviously the weaker euro has helped the industrial footprint within Europe. So I would say these are the key reasons for a stronger 2015 compared to 2014, and given that we expect these trends to remain, so we are reasonably positive. Obviously, Europe will not grow at 6.5% like China. We know that. We are talking always about growth within 1.5 and 2.5 possibly. This year will be on the low end. But coming from a year of deep recession, it's a good step a step in the right direction, I would say.
So it's, the euro economy is on the right track to recover.
They are improving. They are improving from a very low base. They are improving from a very low base. There are some issues, obviously, political issues. We've seen in Greece, we're seeing now in Portugal, Spain should not be a problem. We have the election in December. There are issues about leverage. Leverage is still high. Unemployment has come down. That's good news. That's but still very high. Still high. Youth unemployment is very high. Some areas in south of Italy, where I come from, south of Spain, we have unemployment, youth unemployment, close to 40-50%. So, it's a positive picture, but within a difficult macro environment.
Okay, but I think the ECB also consider about all like this condition you said. So last meeting, the president of the ECB, Mario Draghi, he said maybe the next meeting on December they will maybe
announce a new
stimulate policies for the economy. And but the problem is, if the ECB they expect to purchase more bonds, but the conditions which is with what they expected to buy is getting fewer and fewer. How are they going to manage that? And what is your opinion or your point?
I mean, this is a very fair question. I would say the ECB clearly has clearly said that they will announce something in December. The market is already bought into it, so we are already discounting it. It's difficult. It's not my personal job.
Yes.
I'm on the corporate side, but I would say we expect obviously the purchasing program to be extended after September 2016. That was the first date.
Yes, yes.
And also we expect more quasi-sovereign bonds also to be bought. We may have few additional things, few additional maneuvers, decrease in the base rates, but at this stage I would like to limit to this. But obviously with inflation or now not there at all, actually deflation, and there is room to do more, and so I would say the ECB balance sheet can expand. Going back to your question about liquidity, clearly is an issue, and the ECB needs to. I don't think, because it's an issue, I don't think they will be buying smaller corporate bonds issues. I think they will be limiting to the sovereign or quasi-sovereign type of bonds.
So then.
And so I would say, we should expect some, some news. Obviously, the market is already discounting it, and but clearly the ECB is on a different path compared to the Fed. Fed may announce a Fed hike in December. This is what the market is telling us, and the ECB actually may announce a further purchasing program. So they are a different step in their monetary policy, and that is also the reason why we've seen the weakening of the euro during this year.
Yeah, and I also have a question.
Yes.
According to Merrill Lynch, the European high yield bond spread has already narrowed to 480 BPS, which is lower than the long-term average at 500 BPS. So, in your opinion, are European high yield bonds still a good investment option for investors in terms of capital gain?
I would say, euro yield market is coming from a number of very strong years. So, obviously we cannot expect to repeat the performance we had, for example, in 2012, 2013. I would say that it's true that it's trading inside the historic averages, but it's also true that the quality of the market is higher. We have more double B names, much higher number compared to the historic average, and that tells us that the market is it's a stronger market compared to the past. So while I understand comparing to average historic averages, but we also need to consider that it's a safer market, a stronger market. In addition, default expectations, because of the increased lending out of banks, are going to be reasonably low. Are expected to remain low. So I would say, whether it's I think it's an investment for the medium term. Obviously, the upside is not as high as it used to be. So I think investors need to be warned that they cannot see the historic performances as a lead for future performances. But I would say that taking into consideration the good health of the better health of the European economy, then it probably is worth to still have a look at it, and with at least 6 month view, because it's a very liquid market. It's quite liquid. Bonds don't trade very much, especially now that market makers are not able, because of regulatory reasons, to keep a lot of bonds. So you need to be patient and take the carry. I don't think there's going to be a lot of, in terms of capital gains, probably it's going to be modest.